What if I ask you that out of the two mutual fund schemes, one has got more charges and more taxes? Which of the two will you invest into? Now you might ask, what about the returns? Fair enough. So let's check out the charges, taxes and returns in fund of fund schemes. Hi investors and welcome to yet another video. First, let's understand what is a fund of funds scheme. Now, as the name suggests, fund of funds. Typically, when you invest in an equity mutual fund scheme, the fund manager invests that money which you have invested into other stocks, right? Into stocks. Ultimately, your money is going into shares. In case of fund of funds, the fund manager is investing your money into other mutual fund schemes. So it's like a set of mutual fund schemes, or it's like a portfolio of mutual fund schemes. So typically they invest into 4, 5, 6 or maybe more mutual fund schemes, right? So your money is not directly going into stocks, it is going into other mutual fund schemes, and those mutual fund schemes are ultimately investing your money into stocks, right? So that's why it's called fund of funds, right? Now there are two major problems with this particular category of mutual fund schemes. Number one, charges. You must have heard of something called expense ratio. In simple terms, it is nothing but the annualized charges which you pay to the mutual fund scheme. Annualized charges means every year they deduct that. Approximately it is 2% per annum. So they don't charge you directly in terms of asking you to cut a check, but whatever you are investing, a part of that is going into charges and the remaining is getting invested into the scheme, right? Now in case of fund of funds, you are paying twice the charges. So instead of on an average 2%, you are paying 4%. Why? Simply, if you look at the structure, the fund of fund scheme in which you are investing into, they have got an expense ratio, for example, 2%, right? And the other mutual fund schemes in which that fund is investing into, the scheme is investing into, they also have got an expense ratio, right? So they are charging their expense ratio, and the scheme you are investing into, that is called fund of fund scheme, they are also charging their expense ratio. So you end up paying double charges. That's the number one biggest problem of fund of funds, and it's substantial. You know, 1.5%, 2% every year more, paying more is quite substantial. It is like eating away your returns, right? The second biggest problem of fund of funds. Let's talk about taxation, how taxes are incurred in terms of equity mutual fund schemes. So typically, if you're investing, let's say in a large cap scheme or a small cap mutual fund scheme or a mid cap, flexi cap, focus fund, all these equity mutual fund schemes, this is how the tax structure is. If you're investing for less than 1 year, less than 365 days, and you exit in profit, you pay 15% tax, right? Whatever your profit is. In case you're exiting after 1 year, you are paying 10% tax, but one good part about the long term is you also have exemption of first 1 lakh rupees. So up to 1 lakh rupees in a particular year, your taxes are free for long term, 1 year plus. Beyond 1 lakh, if you make profit in a particular year, then you pay 10% on that, right? That's the simple tax structure for any equity mutual fund scheme. But in case of fund of funds, this is different. In case of fund of funds, it is similar to what it is in case of debt funds. Now how the tax structure here is, for first 3 years, you pay as per your income tax slab. So let's say you are in 30% tax bracket and you exit the fund of fund scheme within next 3 years, not 1, not 2, within next 3 years, you end up paying as per your tax slab, which is, let's say, 30% in your case, or maybe 20% in your case, or maybe 10%, or maybe 0, right? If you exit after 3 years, then you pay 20% tax after indexation. So net, if you calculate, your outgo in tax is also more in case of fund of funds compared to a normal equity mutual fund scheme. Now these two are quite significant charges and taxes. The double the charges, expense ratio you are paying, and second, the tax is also very high, right? So what incentive anyone would have to invest in fund of funds when you are paying so much charges and taxes? So now you might say, what if they are giving exceptional returns? I would not mind paying more taxes and more charges if net returns to me are more, right? So to check that, let's go and check the performance of fund of fund schemes. They have like quite a few schemes available in the market. Let's check the performance and compare with other pure equity schemes in the market, right? Let's do that. All right. As you can see on the screen now, we have selected fund of funds domestic equity category. regular plan, and 5 years period. Now why we are looking at 5 years? Because that's like a sweet spot of the performance you can check for any particular scheme. It's not too short a period, it's not too long a period, 10-15 years kind of period. So 5 years will give you an optimum time range to check in terms of their capability, in terms of the capability of the fund manager, and also the scheme's performance. So if you look at the total number of schemes, first of all in this category, it's only 10, and only 3 schemes have given are existing for 5 years and beyond, right? And the returns are 14.5% compounded annually, 11.34%, and 10.1%. That's for fund of fund domestic equity. Let's check other categories within fund of funds. So if you go there, look at this fund of fund debt. We are not looking at debt schemes. Fund of fund equity we already looked at, domestic. Fund of again gold we are not looking at. Hybrid is mixture of gold and equity. We are again focusing only on pure equity. So let's go here. Fund of fund overseas. So funds or schemes outside India. So again I select 5 years and submit. And now check the returns here. This is a little better than that. This is 17.71%, the top scheme, then 16.58, then 15.82, 15.79, 14.55, and then it goes down to 10.51 suddenly. So you can see that whatever the performance of the top 5-6 schemes is. Now, to give you an idea, to give you a context and the benchmark, let's go and check for 2 other categories, 2 simple categories of equity funds. That is equity small cap. Let's look at equity small cap. Again I look at 5 years. So you just take a note of this: 17.71, 16.58, and 15.82. So first 3-4 have got between 15 to 17% returns. Now just submit for small cap and look at the returns of small cap schemes now. 20.38, 20.26, 20.25, 18, 19.88. Now all these returns are before tax. So once you pay those higher taxes in fund of fund, the gap between the returns will be increased further, right? Now again one more example we can check: equity mid cap. Again this will look at the returns before tax, right, and after expense ratio. This is after expense ratio and before paying your capital gain tax. Now look at this. It is 19.65, 19.32, 18.76, 16.68, and so on, right? So you can see a clear gap of returns between fund of fund category and the other normal categories. That is before you pay the tax. After you pay the tax, as I said, the gap will increase further, right? So this, I believe, is good enough reason, apart from whatever theory I told you before showing you this result gives you the proof that you should maintain social distance, or I would say investing distance, from fund of funds category. I fail to understand why would anyone have any kind of desperation or urge to invest in this kind of a category called fund of funds, wherein you are paying more charges and paying more taxes, and as a result you're getting less returns, right? I hope this was enough for you to get convinced that there is no benefit as such in going in this particular category just for the sake of diversification. You have many other options for diversification. Yep. Thank you so much for watching this video. All the best for your investing journey.